I still remember that morning, March 16th, 2020. I opened my brokerage app at 7 a.m. and saw minus 31% on my portfolio. 3 weeks, $42,000, gone on paper. And you know what I did? Nothing. Because by that point, I already had the right allocation in place. I knew exactly what I was holding and why. While my colleagues were panic selling everything they owned, I just watched and waited. Today, I'm going to show you the exact portfolio allocation for someone earning $4,500 a month. One that survives a crisis and grows after it. No fluff, no vague advice. Specific percentages, specific instruments, and specific actions for every stage of the market cycle. By the end of this video, you'll have a ready-made framework you can implement in a single evening. Let's start with why most people lose money during a crash. Not because the market drops. That's normal and happens regularly. People lose money because they don't understand what they're holding or why. A study by the Dalbar Institute in 2023 revealed something striking. The average retail investor earned just 3.9% annually over the last 20 years, while the S&P 500 delivered 10.6%, nearly 3 times less. The reason is one, people sold in panic on the way down and bought back in during euphoria on the way up. They didn't stick to a plan because there was no plan. When the market starts falling, your brain literally activates the same region responsible for physical pain. This isn't a metaphor, it's neuroscience. Watching your savings lose 20, 30, 40% of their value physically hurts. And the only way to deal with that pain is to have a structure you trust. One you built before the crisis, not during it. Here's what that looks like for real people with incomes similar to yours. Take Adam. He's 32, earns $4,400 a month, works in logistics in Ohio. Before 2020, Adam kept 95% of his savings in growth stocks, mostly tech. When the market dropped in March, his portfolio lost 38% in a single month. Adam panicked and sold everything in April 2020. 8 months later, the market had fully recovered and surpassed its previous levels. Adam bought back in at 22% higher. On that one sequence of decisions alone, he locked in a real loss, not a paper one, a permanent one. Now meet Lauren. She's 37, earns $4,800, works in healthcare in Texas. In 2019, Lauren took a course on asset allocation and built a portfolio with 60% stocks, 20% bonds, and 20% in stable dividend funds. When the market crashed in March 2020, her portfolio dropped only 18%, half of what Adam lost. She sold nothing. She actually bought an additional $2,000 at the bottom. By year end, her portfolio was up 12% from where it started the year. Then there's Victor. He's 40, earns $5,000, works in construction in Florida. Victor never seriously engaged with investing, kept his money in a regular savings account, earning 0.3%. When the 2020 crisis hit, he lost nothing in the market, but he gained nothing either. While others were buying equities at discounted prices, Victor's money sat completely still. Over 2 years, he missed a potential gain of more than 50%. And finally, Sandra. She's 35, earns $4,200, works in IT in Washington. Sandra made the most common mistake. She diversified, but did it wrong. She held shares in 5 different technology companies and thought that counted as diversification. When the tech sector dropped in 2020, everything fell at once. Real diversification isn't different stocks in one sector. It's different asset classes that don't move together. These 4 stories point to one truth. Your outcome during a crisis is determined not by what happens in the market, but by what you did before the crisis began. Now, let's talk about the psychological mechanism that destroys most portfolios. It's called loss aversion. Research by Daniel Kahneman and Amos Tversky, for which Kahneman received the Nobel Prize, showed that the pain of losing $100 is psychologically about twice as powerful as the pleasure of gaining the same amount. When the market drops 30%, your brain interprets it as an existential threat. Survival mode activates. Logic shuts off. You sell just to make the pain stop. The only counterweight to this mechanism is a pre-written plan with specific numbers. When you have a document that says, if the market drops 20%, I do this. You're drawing on a decision made in a calm state, not on an emotion of the moment. This literally shifts decision-making from the amygdala, the fear center, to the prefrontal cortex, the rational brain. Here is the specific portfolio structure for someone earning $4,500 a month. First, the Stability Fund, 20% of the portfolio. This is your financial cushion inside the investment portfolio. It includes short-term government bonds, funds like BIL or SHV, and a high-yield savings account earning 4 to 5% annually. This segment doesn't grow quickly. It exists for one purpose. When the market falls 30%, you pull money from here and buy equities at discounted prices. This is your arsenal for attacking while everyone else is panicking. Second, defensive dividend stocks, 25%. Companies that have paid dividends for 20, 30, 40 years straight and never stopped, not even during a crisis. Funds like VYM from Vanguard or SCHD from Schwab hold exactly these companies automatically. A dividend yield of 3 to 5% annually means that even when the share price falls, it keeps paying you. That matters psychologically. You're seeing incoming payments even on a red market. Third, broad U.S. market, 30%. A simple S&P 500 index fund, VTI or VOO. This is the growth engine of your portfolio over the long horizon. Over the last 100 years, the S&P 500 has recovered after every single crash without exception. The average recovery time after major crises is 1 to 4 years. If you're more than 10 years from retirement, a temporary crash in this segment is a discount, not a loss. Fourth, international markets, 15%. Funds like VXUS or EFA. When the U.S. market drops, international markets often fall less or even rise. This is genuine geographic diversification. Not every crisis is global. Some are local, American. In 2022, when the S&P 500 dropped 19%, European equities fell significantly less. Fifth, defensive assets, 10%. Gold through GLD or IAU, or Treasury inflation-protected securities through TIPS funds. Gold historically rises or stays stable during market crises. In 2008, when the S&P 500 lost 38%, gold gained 5%. This isn't a growth investment, it's insurance. Now let's talk about rebalancing, the most underrated part of any portfolio. Once a year, on the same day, say January 1st or your birthday, you look at your portfolio and bring each segment back to its target percentage. If stocks have grown and now represent 40% instead of 30%, you sell some and buy whatever has fallen. This automatically forces you to sell high and buy low, exactly what everyone wants to do, but emotionally cannot. A Vanguard study from 2019 found that portfolios with annual rebalancing outperform non-rebalanced ones by an average of 1.4% annually over 20 years. At $400 a month invested, that gap compounds into $60,000 to $70,000 of additional capital at the end. Now the 4 concrete steps. Step 1, look at your current portfolio right now. Write down what percentage you hold in stocks, bonds, and cash. If you can't answer that clearly, that's already a signal. This takes 20 minutes. Step 2, compare your current allocation to the structure above. Don't rush to move everything. That creates taxable events. Start with new contributions. For the next 3 to 6 months, direct new money into the segments that are underweight. Step 3, write your crisis plan on paper. Literally 1 page. If the market drops 20%, I do this. If it drops 35%, I do this. Specific actions with specific numbers. Put that document next to your financial passwords. Step 4, set up automatic monthly contributions, even $150 to $200 a month. Automation removes emotion from the equation. When the market falls, the money invests anyway, and you automatically buy more shares at the lower price. Now, the long-term math. If someone earning $4,500 a month invests $300 monthly into a portfolio with this structure, using a historical return of 7% annually after inflation, they'll have $157,000 after 20 years. After 30 years, $304,000 from just $300 a month. Two crisis scenarios. Scenario 1, no structure, panic at a 30% drop, sell, buy back in at 20% higher. That single decision costs an average of 18 to 22% of the total. On a portfolio of $100,000, that's 18 to 22,000 real dollars, lost not because of the market, but because of one panic decision. Scenario 2, you have a structure. The market drops 30%. Your diversified portfolio drops 17 to 18%. You don't sell. You use money from the stability segment and buy more at the bottom. 2 years later, the market recovers. And you didn't just break even, you profited from the crisis. The difference between these two scenarios over 30 years is tens of thousands of dollars, sometimes hundreds of thousands, not because one person is smarter, but because one person built a structure before it was needed. And here's something I want you to understand about why this structure works long-term. Many people ask me, Emily, why hold 20% in bonds and stable instruments when they return less? The answer is simple. This isn't just protection. It's an attack weapon. Think about 2008. Lehman Brothers had just declared bankruptcy. The S&P 500 dropped 38% for the year. The average American investor was paralyzed. But Warren Buffett publicly announced in September of that year, "I am buying American stocks right now." Why could he say that? Because he had liquidity, cash, and short-term instruments he had deliberately kept on hand for exactly this moment. You're not Warren Buffett, but the principle is identical. When 20% of your portfolio is in the stability segment, a 30% market drop isn't a catastrophe. It's an opportunity. You take a portion of those funds and buy index funds at reduced prices. Then the market recovers, as it has after every crisis in history. And you earn more on the recovery than you lost on the drop. A study by J.P. Morgan Asset Management from 2022 showed something that should stop anyone from panic selling. An investor who missed only the 10 best days in the market over the last 20 years earned 3 times less than someone who simply held positions the entire time. 10 days out of 7,300. And those 10 best days almost always occur right after the scariest drops. That's exactly why people who sell in panic miss the recovery entirely. One more important point. Your age defines how aggressive your portfolio should be. If you're 25 to 30, you can hold 70 to 80% in stocks because you have 35 to 40 years until retirement. A temporary 2 to 3 year crash means almost nothing to you. If you're 45 to 50, the structure should be more conservative, 50 to 60% stocks, more bonds, because you have less time to recover. The general rule I use myself: subtract your age from 110. That's roughly the percentage of stocks in your portfolio. At 35, that's 75% equities. At 45, 65%. It's not a rigid rule, but it's a strong starting point. I remember that morning in March 2020, minus 42,000 on the screen. But I felt no panic, only curiosity, because I knew exactly what I was holding and why. I knew this wasn't a loss. It was a temporary change in the price of assets I had no intention of selling. And 18 months later, my portfolio was 23% higher than where it started at the beginning of 2020. This is available to everyone, not just people earning $100,000 a year, people earning $4,500 too. All it takes is a structure built before the next crisis begins. And it will come. It always does. If this video helped you, hit like. It genuinely signals to the YouTube algorithm to show this to people who need this information right now, especially during periods of market uncertainty. Next on the channel, how dollar cost averaging works during a crash and why it turns a market collapse into a wealth building tool. Don't miss it. One question for you in the comments: what percentage of your income are you currently investing? And do you keep a defensive portion in your portfolio? Right below. I'd love to see real numbers from real people.